Greetings, curious minds. Ever wondered how to evaluate the financial health of a company's shares or stocks? Well, the answer lies in ratio analysis. This method, used by investors and financial analysts worldwide, delves into various financial ratios derived from a company's financial statements. The aim? To gain insights into its profitability, liquidity, solvency, and overall operational efficiency. Let's start with the price to earnings, or PE ratio. This ratio compares the current market price of a company's shares to its earnings per share, helping us assess whether a stock could be overvalued or undervalued by the market. The formula is straightforward: market price per share divided by earnings per share. Next up, we have the price to book, or PB ratio. This ratio compares a company's market price per share to its book value per share, helping us evaluate whether a stock is trading at a discount or premium to its book value. The formula? Market price per share divided by book value per share. Then there's the dividend yield. It calculates the annual dividend income an investor can expect to receive from owning a stock, expressed as a percentage of the stock's current market price. The formula is dividend per share divided by market price per share. Earnings per share, or EPS, is a fundamental measure of a company's profitability. It represents the portion of a company's earnings allocated to each outstanding share of common stock. The formula here is net income minus preferred dividends, all divided by the number of outstanding shares. The return on equity, or ROE, measures a company's profitability in relation to its shareholders' equity. It indicates how efficiently a company is using its equity capital to generate profits. The formula is net income divided by shareholders' equity, all multiplied by 100. The debt to equity, or DE ratio, assesses a company's leverage or financial risk by comparing its total debt to its shareholders' equity. A high DE ratio may indicate higher financial risk. The formula here is total debt divided by shareholders' equity. The current ratio is a liquidity ratio that measures a company's ability to cover its short-term obligations with its short-term assets, crucial for assessing financial stability. The formula is current assets divided by current liabilities. Similar to the current ratio, the quick ratio, or acid test ratio, is a measure of a company's short-term liquidity. However, this ratio excludes inventory from current assets, providing a more conservative estimate. The formula is current assets minus inventory, all divided by current liabilities. Finally, the earnings growth rate. This metric evaluates the rate at which a company's earnings are growing over time, often expressed as a percentage. The formula is the current year's EPS minus last year's EPS divided by last year's EPS, all multiplied by 100. By analyzing these ratios and comparing them to industry benchmarks and competitors, you can gain valuable insights into a company's financial health and the potential attractiveness of its shares as an investment. Ratio analysis, therefore, becomes a vital tool in the arsenal of investors and financial analysts, illuminating the path towards informed and strategic investment decisions.